Just to finish up, we had two last charts to cover in section 1. 1-29. We had talked about the price cycles and the thing with time cycles and how they overlap. And this is just a diagram I put in. If you look at number 1, showed what a 13 would look like measured bottom to bottom. Up at number 2, a 13 measured top to top. Number 3, a 13 measured again bottom to bottom. Number 4 would show like a 9-week. Number 5 showed a little short-term 4-week cycle that might have been measured just after a low, just before a rally high, from a low to a high. But they start to overlap. And then you had that 26 up at number 6, measured from a top to a top. But as you start to see time cycles overlap, and as I had said, sometimes you'll be able to measure from a high going into a low, and a low going into a low. You want to look at where your price cycles are. You want to look at where your momentum is. Is it above or below 0? If it were going into a low, like down here at number 7, coming into this low at the latter part of the 6.5-week cycle, maybe your momentum was making a new low. But when it started up, you had high to low, high to high, a low to a low. You had a lot of cycles coming together that were saying something is going to happen in here. Or let's be aware of and alert to the possibility we could be making a low. If it started to come out of here, out of this low, and started to go up, maybe the momentum was below 0, below that 0 line. And as price started to rise, the momentum also started to rise. So you had price, momentum, and time coming together. Chances are, too, from the high point on the left-hand side of the chart, as price worked its way down into that low, you probably had sentiment figures to where most people were turning more and more negative on it, to where you reached a point where everybody was bearish, expecting lower prices. So now you're incorporating price, momentum, time, and sentiment. You have your 4 major categories coming in. Now you're approaching the reward to risk ratio, possibly, when I had mentioned earlier, about 6 or 7 to 1, and a 50-50 shot. Well, if you wanted to take it, you know, it's like buying a lottery ticket in the sense of 50-50. I try and look at probability and my probability of a trend change based on the price, momentum, time, sentiment, but the rules that we will go through, the range of the RSI, the value of momentum, where the time cycle is. So even though down in here at that low point, it may have been 6 or 7 to 1 with a 50-50 shot. Excuse me, but as price started to move up, momentum started to move up, you go from a 6 or 7 to 1 with a 50-50 shot to maybe a 5 or 6 to 1 with a 60% probability. Then you get a couple crossovers in the 0 line on momentum, and the moving average starts to turn up and cross up to the upside. The shorter term moving average turned above the longer term. Then you're getting into a 5 or 6 to 1 with maybe a 65 or 70% probability. But it's just a good, this chart I like because it shows you how cycles can overlap. What you may want to do, I still keep my charts by hand, even though I have the computer to do them. And we've got acetate paper that we scaled with the time cycle, so you can lay it on price lows or on the RSI chart itself that you're drawing by hand. And I highly recommend you do charts by hand. But you'll be able to overlap that and slide it back and forth and see where the cycles, and just mark them on your chart. And you say, uh-oh, price, momentum, time, and sentiment are coming into this area. So then start doing some other work and going down your checklist. 130 is directly from, what was it, page 44 of not Wells Wilder's book, but Earl Hattity's book on contrary opinion. and was his bullish consensus meter. When we had talked about sentiment, we said, 100% bulls and 0%. Now, when they calculate the percentage, the number that they put out, if they poll 100 advisors and 60% are bullish, the number would fall at the 60% level. I think it's Michael Burke of Investors Intelligence in New York, or other analysts out there who write services that say 60% bulls, 40% bears. But when you get a number from bullish consensus, it is the percentage of traders that are bullish. So if 80% are bullish, you're going to see an 80 value. But you can look and see where the 80 and the 70, where it says market is overbought, prices could turn down. We'll see when we get to RSI values and we do the range analysis, how it's very close to that, the 80-40 rules. The 60-20, if you look at the 30 and the 20, on the lower half of the chart, market is oversold, prices could turn up at any time. 30 is your normal parameter, 30 and 70 for RSI, very close to the 70 and 80 of bullish consensus values. Think back to the boat of most people getting on one side or the other, and who's going to stay dry. When you get down below 20, sharp price reversal from down to up is imminent. Market is severely oversold. When a market gets overbought or oversold, it can stay that way for a while. And just because you hear the term the market is overbought and it's too high, doesn't mean the market can't go higher. You want the market to go higher, go short when you think it's overbought. And when it goes up and stops you out, you say, well, it can go higher. But my broker told me the market was extremely overbought. We ought to take our profits on the stock or whatever it is at this point because the market's too high. And just as you get out, the market pulls back, you feel great, and then all of a sudden it explodes to a new high. So we'll see when we get into the range analysis, which is our next section. But I just wanted to finish up, and even though we had run over on the tape, I just wanted to cover these last two charts with you from the first section. This first section, I think, also you ought to review occasionally. Listen to the tapes over and over. I have had people who have gone through the class who, even though you're sitting there for the first time, hearing it, you're listening, you're trying to pay attention, you're making notes, you're thinking, if I said something, boy, that triggered a trade I should not have made before, you may miss something. So the first time through, you're going to pick up a lot of it. The second time you go through it, you'll pick up things you didn't hear the first time. The third time through. I've heard people who have called me and thanked me they took the course. And I said, when did you take the course? They say, it's 6 months ago, but this past weekend, I listened to the tapes again to keep myself focused. Section 2, the basics. Now we're going to get into RSI, which, as I said earlier, is probably the most dynamic indicator you will ever see because it incorporates everything we learned in basic about price, momentum, time, how to follow sentiment values, how to use the RSI as a sentiment index. And we will get into time periods, range. But your first one there, definition of RSI on chart 2.2 and calculation of RSI time period. Let me do the time period selection first. The standard value that I use for every single chart that I follow is 14 period. Every chart. From pork bellies to IBM to stock indices to bonds, I use 14. Even on my hourly charts, I use 14. If you are trading financials, you might also want to look at 21 for treasury bonds, euros, T-bills, and stocks, and stock indices. You're expanding the time period out to 21 because stocks and financials are generally a little slower than futures contracts and commodity prices. The 14 period oscillator is set at half a cycle length. When you're looking at studying momentum analysis, if you identify a cycle, and I talked to Wells about this, he looked at a 28-day cycle. For those who follow the 28-day cycle, you see the moon full every 28 days. It's a lunar calendar. It has an effect on people. You talk to policemen and firemen. You will find that policemen and firemen are busier on full moons because people get crazier. Hence the term lunar cycle lunatic. With the cycle at 28 days, if you set your momentum oscillators at half the cycle length, you will catch a bottom and then a crest and then another bottom. They will be usually 28 days apart. If you want to play around with it and use other time periods, this is why I suggest 21 period for financials, for currencies, gold, silver, crude oil, 25 days. Because there's a 50-day cycle that a lot of traders trade in the currency market. So you're taking half of that, you're using 25 period. But whatever you're going to use, realize, in my personal and professional opinion, the 14-day is going to be the most accurate. For shorter term traders, hourly charts, I think 14 period is fine. When you get less than an hour, you may want to drop it down to 9 or 7. If you're looking at an hour, you can look at a 9 as well as a 14. If you're looking at 30-minute, 15-minute, or 5-minute charts, you might want to look at 9s, and when you get down to the 9 on the 30 and the 15, when you get down to the 5-minute charts, you might be looking at 7 period or 5 period. And we will get into examples of how to use it, even a 3 period for very short-term trading, but only as a filter. Okay? Traders were trading 5, 3, and as I said, I've met some people who even trade 1-minute charts. The fellow I spoke to with the 1-minute chart, I've bought him at least up to a 5, and he's considering going to 15. But what I had mentioned during the basic market structure segment is, if you look at the time period that you're trading in and keep an eye on one time period longer, so that you're not blindsided, so that you're not actually turned around and if your daily trend is up and your weekly trend is down, okay? That's a market that's going to be very choppy because the major trend being weekly is going to be down. The daily trend being up, you're going to see the daily charts well supported, but it's going to get overextended and go to new lows because of the longer term trend. Same thing as the shorter term trend can affect the longer term. If on a short term basis the market is extremely overbought, say on an hourly chart, you're going to have a sharp reaction. It may be the short term high that the market may sell off for a couple days. And then it'll get back into perspective where the short-term trend is very oversold, the daily trend is still up. That's the place to be buying when your shorter-term trend is up. So when I look at perspective, I start weekly and then go to daily, because the weekly is setting the intermediate trend for me. And I look at the daily charts and trade in the direction of pullbacks if they're both up. If you are a end-of-day trader, you can look at your hourly as your time frame down and your weekly as time framed up. If you're trading less than an hour, some traders trade 30, 15 minutes, then they should keep an idea on what the hourly chart looks like, because that's going to set your longer term trend. Your 30-minute or your 15-minute chart will set your shorter term trend. Right. if you are contemplating taking a trade, if you know that the longer term trend is up and you get a pullback in the time frame you're trading, if I'm looking at a weekly chart and I say that weekly trend is up but my daily is very oversold, I would want to see a point where I could get in on the daily chart to where it would move up because it's in the direction of the weekly trend. When you get overextended short term, it will affect the market on a short-term basis. Longer-term trends smooth out volatility. Short-term trends can cause havoc and confusion. Okay? So this is why I always say go to one, keep a perspective on one longer time frame than you're trading in. For most people that are trading markets on an intermediate type basis, they're going to take a position and hold it for anywhere from a week to 2 weeks. That's been my experience talking to people, anywhere from 1 to 3 weeks. The shorter term traders, the day traders, can be in a position for as little as 15 minutes. And they have no concept and really don't care what happens on a daily chart if they're trading 5-minute charts. But if they followed that daily chart, they would identify points where momentum had sold off. This is in the case of an uptrend. Momentum had sold off, and the daily chart is saying, okay, it's oversold. And then when the hourly chart got oversold, both time frames were ready for a good move up, the short-term trend and the daily trend. So you're trading in the direction. It's also another way of helping to identify what your trend is. The conventional approach says that you get a turn in the short-term trend. That will change first, followed by the intermediate term trend, followed by the long-term trend. But you have these time frames interacting and influencing one another all the time. And I think the conventional wisdom is if it turns up short-term, that's positive short-term, then the intermediate turns positive, and that's positive, then the long-term turns up. But at intermediate junctions and turning points in the market, they will all tend to show the same thing. Okay? If the market is oversold on a daily and oversold on a weekly, and then there's a big rally in the morning, and then it sells off in the afternoon, and then it will usually come back in the afternoon, back to the upside, because all three time frames or perspectives are starting to turn at the same time. So use a 14 here with time period selection, 3, 5, 7, and 9 for shorter term traders, 7, 9, and 14 for intermediate, but then 14 and 21 for the longer term if you want to go to 25 and even 45. I used to do these by hand back in '78 with a calculator and paper and pencil. And you're following 6 or 7 different worksheets for one market with 5 or 6 different time frames on them. The patterns that I found that were the most convincing and also showed the strongest probabilities were the 14 period on close. I've had people at the office who have been there and written computer studies and tested out and say to me, I know 14 is not the best one, and we had that computer cranking all day long. And when we went back in, she was a little, she was taken back by the fact that the thing kept saying, go back to the 14 period. So my standard has always been, and I think always will be, the 14 period. I've been using it in 14 period since 1978, and I've seen gold and silver explode in the rallies in the late 70s and early 80s. I've seen everything from bonds to currencies and everything else, and the 14 has been the most reliable. The chart, or page 2-4, is taken directly from Wells's book and has his definition of the momentum oscillator concept and the formula there for you that you can plug into the computer, but most software programs already have it in there. my definition is basically the same, but that it's the best thing, the best indicator I've ever run across. There's no other available indicator today, nor I think will be developed in the future, that offers as many things as this does. But I went through my approach to momentum and wanted to put his definition of it in there, and the formula in case you want to program it in and do some customized formulas in your computer. But I took that formula and that worksheet, which we gave a yellow worksheet to, is your next chart, chart 2.5. That's the original worksheet that Steve gave me, and every day to do these by hand takes 1 minute per chart. 1 minute per chart, and then you plot it on graph paper, and you have a hard copy that you can refer back to, you can study from. You see the way I mark charts with RSIs, let the computer print the RSI out, and then go back in and mark the prices on it for lectures and workshops. But we have the worksheets for every market we follow, and you may think it's a little tedious, but especially with futures, with being only 35, 40 markets you're really going to follow if you want to follow them all. With stocks, you want to have it computerized, be able to look at the patterns and let the computer do it. But I use the computer more for moving averages, plotting charts, trading bands, whatever. But this is my favorite part of the day, is seeing when that market closes and being able to calculate that value as soon as the market closes, not have to wait for a database till I can log on to, not until 5:30 in the afternoon, but have the data and go through 15 markets and have the charts done by 3:45, and then the next day know whether I'm going to be trading or not based on what I see, and place 2 orders, or place 2 phone calls, one to the broker to place an order, and one to the golf course to set up a tee time. Because there is nothing you're going to do, no amount of worry, frustration, upsetment, hair pulling, gut wrenching, maylocks and tums taking, that is going to affect a market. A market is going to do what it's going to do. What your job is to read which way it's going. And this is the only thing that I've found that is powerful enough to say, if my computer crashed tomorrow, I've got a worksheet. Think about it. If your computer went down, how many traders, and I've talked to currency traders and bond traders and everything, that say, I'm blind. My computer's down, we have no data, I'm blind. If you did your worksheet the night before, you want to do hourly charts? Get your broker to turn around and give you the hourly closes. Calculate the charts by hand, do a hard copy. Your computer crashes, you still have an idea what's going on. Okay? They're your best friend, and it'll take you 1 minute per day per market. 2.6 and 2.7 are just examples of different time periods to use. 5, 7, 9 on 2.6. You'll see that the RSI line moves pretty much the same, except the amplitude is going to be a little different based on the length of the time period selected. Shorter term traders may want to put something like this on a computer, on your screen, 5, 7, and 9, or 3, 5, and 7. Longer term traders may want to put 9, 14, and 21. Currency traders may want to put 9, 14, and 25. But being able to look at different time periods all at the same time. And this is just a 1x3 format, but you could do 2x5, as many windows as you wanted. Now that's your first tool as far as the RSI. Your second is your triangle, because then you can just slide it back and forth and give yourself an education to see how they line up. I have a friend who turns around and says, when things line up like they should, it's like a no-brainer. You just step up to the plate and buy, and we'll get into how to identify where to buy, a conservative approach, a middle-of-the-road approach, and a very aggressive approach. But being able to see the different time periods all at the same time, and you can fit it to your style, whether you're short-term or longer-term. But please keep a 14 on whatever market you're trading. And if you decide not to do your charts by hand, at least keep, if you're a futures trader, and at least keep the 1 or 2 or 3 charts that you're going to trade those markets most often. Like for some it may be bonds and currencies. For somebody else, gold. You always want to have a daily chart so that you can just get away from the markets, get away from the phones, go sit somewhere, have a cup of coffee, and just look at the RSI and which way it's moving. That's 2.6 and 2.7. 2.8. Now the fun begins. Parameters of RSI. Everything we're going to go through now is going to be based primarily on the 14 period. I'll show you how to adjust it a little bit to fit shorter term periods. But your normal value is going to be between 0 and 100. We had talked about sentiment values, percentage of bulls, 0 to 100. When everybody's bullish, you don't want something. Look for a reason to sell it. When everybody's bearish, start watching for a reason to buy, a technical input to buy. But your normal range on the RSI is 100 to 0. That's the value of it, the value can fall between 0 and 100. The normal range, now this is what most people consider the normal range, 70 and 30. Number 2 there, normal range. Some people will adjust it up. It was interesting when I first started lecturing in 1986, the people that sat in the audience at that time, 70-30. But as I started talking about range rules and everything, each year people said, well, the normal range is not 70 and 30. It depends whether you're in an uptrend or a downtrend. But when you read Wells's article, his chapter, he talks about 70 and 30. It's basically with the idea that when the market is up at 70, when the RSI value is up to 70, has a 30% chance of moving higher and a 70% chance of moving down. We'll get on the next chart. We'll get to that point. But when it's down at 30, it has a 30% chance of going lower and a 70% chance of moving higher. But what we will find is because most people are by nature bullish and understand buying low or buying something and see the price go up, and when it starts to move higher, they get more and more excited, and the euphoria gets caught up. They get caught up in all the excitement that the market tends to go through 70 and continue higher. It gets up near 80 before it puts in what we had talked about back in the basic market structure saying. Momentum peaks to where it got a little too far ahead of itself. And then sells off, but when it pulls back down, those that missed the opportunity to get in before are willing to pay a higher price for it. So it does, as it starts, the RSI starts to drop back down as price is falling, people are coming in and buying. So that it doesn't actually get back down near the 30 level again. So it gives you that range for number 3, the bull range at 80-40. Number 4, the bear range, when markets have changed direction and you see prices falling. Think about how you feel when the price is falling and you're losing money. I'll get out at any price, just give me a rally. So when the market starts to put a little rally together, you're not going to wait and see it get back to your price. You want to cut your losses. So by cutting your losses, the market never really quite gets back, and the RSI never really quite gets back to the 70 level. So as it starts to go up. When it gets overdone, it gets down near 20. But look at the difference on number 2 between 70 and 30. Number 3, 80-40, and number 4, 60-20. Still the same 40 points. You're just shifting up and down. Now those parameters are pretty much based on the 14 period. This is why I say even if you're a shorter term trader and you're using like a 9 period or a 7 period, keep an idea where the 14 is. Because a 9 period is going to go higher than 80. May get to 85. 7 period may get all the way up to 90 or 95. And when markets really get flying, I remember in 78, late 78, early 79, when the gold was running and the currencies were running, the dollar was crashing. 14 period RSI value on a Swiss franc or a gold, 94. But what was it? It was above 80. It was in an uptrend. And when it pulled back, it would pull back to 50 or 40 and turn up again. So just because it's above 70 or above 80 and it's putting in momentum highs does not mean that's the end of the market. Remember we talked earlier about the fact that just because you hear a market is overbought doesn't mean it can't go higher. You want to see it go higher, put a big position in on the sell side. And when it goes through it, and you throw in that order to cover, there's more buying hit it and it drives it even higher. 2.9 is an example of those parameters in the normal trading range. The middle and lower panels there for the uptrends and the downtrends, those small letters A, B, C. Let's look at A first. In the middle chart, uptrends, RSI had gotten above 80, and there's a price of A. Over at B, the price and the RSI had both hit a higher level than they did at A. So momentum and price went up, RSI went up. At C, the price was greater than A and B, than what it was at A and B, but the RSI was not. On the bottom, with X, YX, or Y greater than X, and then Z greater than X and Y, the price was making higher bottoms at each point, and the RSI was slightly above its previous lows, but it was in this 80-40 range to where you continued to see higher tops and higher bottoms in price, and the RSI had shifted upward. The inverse for the downtrends, if you look at the downtrend chart on the bottom, A, then the price at B was less than A, and the price at C was less than A and B. And the RSI comes up near the 60 level. Lower tops, lower bottoms. The prices down at the bottom, X, Y less than X, and Z less than X and Y, you're starting to see lower lows, lower highs. Okay? Your next one, 210, is what we had talked about, the standard values of 14, where the 70 and the 30 are. To 11, and I put these charts in a book this way and moved them up a little bit because what you may want to do if you have a computer is go back and print out some of your charts at home. And if you think a market's in an uptrend, in this case 211 shows the 80-40 range, you might want to go back and just print some charts showing where the RSI had been up, and write some prices on the RSI and just cut it out, maybe paste it on there so you'll have examples to study from. You'll see examples of it in your own trading. But I think if you apply these rules to your analysis, I've always said that if you go back and you study previous trades that you made, if the market was in an 80-40 range and you were selling and getting stopped out and losing money, you were on the wrong side. If it was in a 60-20 range and the market had been in a downtrend, you kept buying and it kept dropping the lower lows, you were getting stopped out. But generally, markets that you traded and you traded well and made money on, you probably got out too soon because it stayed in that range and continued higher if you were long, and it was in the 80-40 range. Markets that you were continuing to get stopped out on, you were probably on the wrong side. So these range rules of 80, 40, 60, 20 show, especially here on 211, show that shift to where most people are by nature bullish. And all I wanted to do was show you, just shift the range up, and you'll look at a little range of 70 to 30, or excuse me, 70 and 80. And then also 40, 30. You still have that 40-point range of 80, 40, and 7, but you're shifting it up because the momentum, the sentiment, and everything are running to the upside. 212 is a market that is sideways to up. 212 is a market that's sideways to up, to where it's not really getting above 70, but it's not really getting below the 45 or 40 level. It's just kind of caught in the middle. When we talked about transition markets, markets that are going sideways, well, it might be just a gradual uptrend that when it pulls back down to this 40 level, it's never really getting down below the 40. But it's not really taking off and going to the upside. It's probably a market that has been up and is going through a transition or a resting period, a consolidation, before it starts the next leg up. $213 is your downtrend range, your 60-20 rule, where you shift the range down. And each time it comes back up to 60, we'd see lower highs. Each time it got down below the 30 and started approaching 20, we'd see lower lows. Again, back to basic. Lower highs, lower lows in price, and you stay in the lower part of the chart. 214 is your range for a market that's sideways to down, to where it's really not even strong enough to get up above 60 and is topping at this 55 and 50 level. But it's weak enough to get down below and spend a lot of activity, a lot of time down around the 35 and 30, but not as weak as to drive it all the way down to 20. But this is a market that's gradually descending. One that's making the lower lows, lower highs, but not extremely volatile and not extremely volatile and extremely negative to where it's going down into the 20 range. But each time it comes back up, it's failing to get it even above near the 60 level. Which leads us to 215 with the values and what I call a range shift. To where if you look at area A, if the RSI had been in the area of A, and then all of a sudden you started to see the market sell off a little bit and the RSI activity was in the area of B, what did you have? You had a shift from this 80-40 range to the 60-20 range. The market is showing on a trend basis, it's going from up to down. Your lower chart, if the market had been in a downtrend, and you were in the 60-20 range, area of C, and it started to move up, something affected the market, fundamental news, whatever, but fundamentals, always remember, for people who can't draw trend lines. And technicals will help you interpret fundamentals, but fundamentals cannot help you interpret technicals. So if you're in this area of C and something is starting to change, and the RSI starts to come up, momentum starts to come up, look at 60 and 20. Remember we talked about price cycles? Look at the high that you had in that area of C in terms of price, and look at the low you had. And figure out what your cycles of 8s are. those 12.5% retracements. You start to move into the upper half of those, above the 50%, above the 60%. Something is happening, it's changing. You're going to see the RSI start to reflect it and start to go higher. It's going to break the 60 line, then when it pulls back, only come back to the 40. We have examples of it we're going to go through, but I want you to understand that when you get this shift, you should shift your thinking. I think it was Jesse Livermore that said, there's neither a bull side nor a bear side, but the right side. Okay? Don't be bullish, don't be bearish. Be right. Identify trends and trend changes. This 80-40-60-20 rule, when I first look at a chart, that's the first thing I want to see on an RSI. Are we in the upper half? Are we in the lower half? That should immediately tell you, is the market an uptrend or downtrend? Okay? When you go from here, you can go right to those things we went through with simple momentum. Is it above zero, below zero? Okay? But the first thing you should see, when I first started lecturing, I only put up an RSI chart. I wouldn't put up bar charts. And people got on me about it. They said, you don't want to look at a bar chart. I said, why should I look at a bar chart and see a market where the spike in the bar was not accompanied by a spike in momentum? So I started looking at the RSI first and then looked at the bar chart. Being able to identify trend just by looking at range, which is why I call range rules. When we get to we have a chart, a page in the book with the basic 5-point checklist. The 80-40-60-20 rule is one of the first ones on this checklist. I don't care if you're trading stocks and have never traded futures, if you're trading futures and have never traded stocks. It's the first thing. If I gave you a chart, if you're a gold trader, and I gave you a stock chart on IBM, and I gave you an RSI chart on IBM, and you were able to see what the RSI values were and plot those prices, first thing you should look at, is it 80-40 or is it 60-20? And you'll amaze some other stock traders that say you don't trade stocks. I'd come out with a recommendation. We looked at a chart on Chrysler, and it talked about Chrysler and started looking at the range and the fact that it was turning up. I don't trade stocks. I'm known as a futures trader. But the 80-40, we were going into this 80-40 range and it was starting to move higher. So it looked like the trend was turning. But it's the first thing you should notice on the chart is the range that it's in. Which takes us to the next couple charts on using these range rules and how to read charts as to whether they're in the upper half or the lower half and get the first input as far as your trend analysis, which to me is the basis of all successful trading. Identifying trend first. Be amazed how many people say, where do I buy? You say, well, we want to look and do some trend analysis work first. Well, it doesn't matter which way the trend is, but where do we get in? Which way do we get in? Which side? How many? And I say, just be patient. Well, you know, we don't want it to get away from us. Oh, that's true. It may, you know, the market's only going to be trading until next Thursday, and then all trading is over. People are in such a hurry all the time. But trend analysis should be foremost in your mind, and identifying trend change and looking at this 80-40, 60-20 rule will give you where is the trend, is it shifting, is it changing. When you are selecting the time frame and the time period, using the 14 as a standard, the rules of range or the range rules of 80-40 and 60-20 will apply. If you shorten the time period to say 9 period, 7 period, or 5 period, you're going to increase the volatility or the amplitude of the RSI line. It's going to go probably above 80, and it's going to go below 20. If you want to study it, you turn around and take a 3-panel chart, 3-window chart, put a 14 in the middle. Top chart maybe go 3, 5, or 7. And on the bottom panel, use 21 or 25 or a longer time period. But the longer the time period, the smoother the line, the less volatility. The shorter the time period, the more volatile the line is going to be, the wider the range is going to be. But using it as a standard with the 14 period, it's going to help you to focus on trend, and even using it on weekly charts, use 14 period. If you want to play with shorter time frames, use the shorter time frames in conjunction with and after looking at the 14 period. Look at the 14 first as your guideline, and then use your shorter term time periods to try and optimize or get a further input for it. But always keep track of what it is. It might be 85 if it's 5 or 7 period. It might go all the way down to 15. It may move at 5 or 6 points either way.